Welcome. Thank you so much for joining this webinar. We will today, just in terms of what to expect, we'll mostly focus on the Climate Tech Portfolio Fund 3. We have a first close coming up on June 20th. We love to take you through the bigger story of why this fund makes a lot of sense, but then mostly focus on what's really been happening on the ground and how we've been preparing for this first close. We are getting a few funds very close to IC and would love to take you through those opportunities. What we won't be doing is talking about carbon equity more broadly, where we're at, nor what other opportunities we have on offer, including the infrastructure fund. For that, you can find more information on the website or the portal. Please feel free to introduce yourself if you like in the chat. You can do that either only to us or to everyone in the webinar. And if you have questions, we kindly ask you to ask those in the Q&A section. You find that right next to the chat button, and there we'll make sure to record all questions. If it's opportune, we'll answer it during the webinar we're presenting, and otherwise at the end, we'll have 10 to 15 minutes for further questions. In terms of the agenda, we're going to talk about, first of all, the climate investment opportunity, how we perceive it. And then we'll talk a little bit about what the climate private equity universe looks like and how it's been maturing over the last couple of years. Then we'll really dive into Portfolio Fund 3. What fund are we planning to construct? So what does the overall portfolio strategy look like? And then, as said, really spend some time on the funds that we have coming up for IC. After that, we'll still take you through our general investment and impact approach, just so you have a sense of how did we actually end up with that top 3. And finally, we'll talk a little bit about how to get started, next steps, and then go to Q&A. I'm Liza Rubinstein. I'm one of the co-founders of Carbon Equity, and I'm head of impact. I lead all of our impact strategy work, due diligence, reporting, communication, whatnot. I'm not doing this webinar alone. I have Wiebe Visser with me on the line. He is our managing director. He really heads the whole investment team. He's a background at Alpinvest, so he's been investing in funds for close to 15 years. And finally, Carolina is also on the call, our employee number 1. She'll be moderating the Q&A, so don't be surprised when she pops up to voice over one of your questions. Very quickly, I'm assuming all of you know this, but what is carbon equity? Carbon equity is a platform that enables you to invest in the best climate, venture capital, and private equity funds. And through that, use your capital to fund breakthrough climate solutions. What we think is really unique in terms of what we do is we create unique access, both by scanning all of the funds in the world and then picking the very best ones and making sure that we also get in, which sometimes is not easy with the most popular funds. Now, what is it we really do? Our secret sauce is selecting those funds. We have an investment team of 7 dedicated to only making sure that we really do our homework before we step in. And who are we doing this for? By now, we have a community of more than 700 investors, going on 800. And yeah, happy to be providing this service. The climate investment opportunity. So I give you one bad news slide. I'll keep it at 1, but climate change is real. It's not about 1.5 or 2 and 2.5 degrees that you typically read about, but it's about what that 2.5 degrees means. Because what you see here is a 2.9 degrees. Let me actually tell you this correctly. On the right-hand side, what you see is that with more average global warming, extreme weather gets worse. And that's really the reason why climate change is so scary. We get more droughts, more extreme rainfall, more storms, more of everything, including more hottest days of the year. And this is a chart that really scared me from the latest IPCC report, whereas if the world warms by 7 degrees, that will mean that the hottest day of the year will be more than 7 degrees hotter. And that's really quite dangerous for the health of many people. Okay, so that's not what we want. What is it that we do want? We want to get to net zero. And to do that, we need to transform 5 industries and build a 6th one. So basically, all of the global greenhouse gas emissions currently take place in one of 5 industries. We have energy production, everything we do to make electricity and fuels. That's 33% of global emissions. Then you have mobility, all the ways in which we ship people and goods around, that's 15%. Industry, everything that we make, so steel, concrete, plastics, chemicals, you name it, that's 24% of emissions. The built environment itself is responsible for 6%, and that's because there we only count the emissions that are really being produced in buildings. So through the electricity that is used and the gas that is burned for heating and cooking. And finally, we have food and agriculture. That's 22% of emissions. That's everything that, well, both the forest that we cut down to grow the soy to feed the cow, and then the methane that the cow burps. Finally, we have carbon management. This is the industry that we really need to build. So this is carbon capture and carbon removal, two technologies that are essential according to all experts to make sure that we actually get to zero and probably reduce some of the overshoots that we'll have before that. Below you see 6 examples from our funds of companies that are trying to solve each of these sectors, but we'll spend a little bit more time on that in a bit. I think this is the most hopeful slide that I have for you, which was one of my biggest insights during my time at McKinsey, which is we know exactly how to solve climate change. Like we have a very clear roadmap of what technologies we need, by when they need to scale, what needs to be done to get them to scale. The picture is very clear. And the other part is that many of these technologies are already, there's only 5% of them that are not proven in the lab. So 95% of them also are considered to be very viable to get to that scale. So of, again, that 100%, 10 is currently mature. That's on the right-hand side, global deployment. These are the technologies that are at cost parity or cheaper than the alternative, that are rapidly being rolled out. Everybody's buying them, and it just makes a whole lot of sense. Solar panels are a great example. By now, majority of all new power installed is solar. Plant-based dairy is a great alternative where it's really gone mainstream. And then 45% of technologies are in commercialization. This means that you can actually already buy them. It's not that hard, but it's still a little bit harder. Maybe they're a little bit more expensive. Maybe they're a little bit more inconvenient. And because they're not fully at parity yet, we call them early commercialization. But all of these technologies are fully on track to getting to global deployment and getting to that cost parity. You can think heat pumps for homes, biofuels, electric vehicles. Then another 40%, going a little bit more to the left-hand side, is the early innovation stuff. This is the stuff that's been proven in the lab, that's been proven in first pilot plants. So yes, this technology is absolutely viable. But if you want to buy it, it's going to be a little bit hard because there's not that many producers of it yet. And there's not that much being produced yet. So here we talk about synthetic fuels, fuels that are made from CO2 and hydrogen, or planes that fly on hydrogen. Concrete that's made without creating any carbon emissions. It's really in the early innovation now because one of our portfolio companies, Sublime Systems, last week poured its first actual concrete for an actual building. So it is commercial, but still very small scale. But also, for example, electricity-based steel making. And then the final 5%, these are kind of the grand ideas that if they succeed, they make everything so much easier, like nuclear fusion. If we manage to pull it off, electricity will become so cheap and abundant that everything thereafter will follow. But we're not really sure if we'll succeed and by when, and we shouldn't really count on it. So it's worth kind of doing a bet of 1 in 100, but let's not let the entire transition depend on that. So we exactly know what we need. Great news. Less great news, many of these technologies still need to scale and they need capital to scale. Fortunately, the capital is coming and the scaling is happening. And let me take you through how we're looking at what's really driving this energy transition. On the bottom left, we see probably the biggest game changer for getting to net zero of the last 5 years, which is geopolitical competition. About 8 years ago, when I was studying political sciences, it was not a hopeful story. Countries were competing with each other. We expected that it would be a race to the bottom. No country would be willing to make early sacrifices to stop climate change for the long-term benefits. We didn't really know what was going to happen. And then everything flipped and energy became a matter of national security and climate tech became a matter of national economic growth. And many countries started developing extensive policies to support climate tech and clean energy on domestic soil. The US really led with the Inflation Reduction Act. It's a policy that officially in the budget, they put 380 billion US dollars, but in practice, there's no cap on how much money will be available. And certain experts expect that the actual support for climate tech will land at 1 trillion or even north of that. The caveat is that only technologies that are produced on US soil are subsidized. And that means that it's a big boost for local economy, but it also means that other countries need to respond. Otherwise, just so many companies will move to the US thinking that they'll have a better market there. And so the EU is responding, China is responding, India is responding. Now, many other countries are also setting up more domestic-based policies. A second big driver, obviously, has been in Europe, the war with Ukraine, and a big push for more independence from gas. Now, what does that lead to? That leads to a whole lot more capital coming into the space. Climate, venture capital, and growth equity was 50 billion last year. Overall climate private markets, 200 billion was invested. It's really becoming an established market. And that all of that capital is pushing many companies to grow and to learn. And this is another big wonder of the whole transition of tech generally. But the more demand there is, the more we invest, the smarter we get, the more efficient we get, the cheaper it gets, the better it gets, the more we invest, the more people want it. And that by itself is a whole other loop. Multiple technologies are really showing that with sufficient support, again, they can get to that parity and beyond and get cheaper and beyond. And we see that learning curve now taking place in more and more technologies. That's also fueled by a demand for green products. So when products are as cheap and they're green, the vast majority of consumers prefers them. But even when they're still a little bit more expensive, more and more consumers and corporates are willing to buy. For example, green steel now has a very clear green premium of 10%, and still people are buying it. And a final push in this whole factor is corporate action, where more and more corporates are setting really scientifically based, independent, verified targets for net zero by now 4,500 multinational companies. And because of they're setting the targets because they see the demands and they see that need for their long-term competitiveness. But in turn, that motivates them to invest more in climate tech, to adopt more climate tech, to develop more climate tech, further accelerating this spinning wheel. And that means that many climate tech markets are poised for strong growth. So what you see here is 4 climate technologies: sustainable aviation fuel, low carbon hydrogen, plant-based food, and solar energy, and how much these markets are expected to grow in the next 5 to 10 years. Now, the very much more established markets like plant-based food, solar energy are expected to grow 2.5 to 3 times, which is still a whole lot of market size that is being gained. It's just that the growth does slow down once markets are already more established. And the smaller markets are really seeing the strongest expected growth, like sustainable aviation fuel expected to grow 15 times, low carbon hydrogen expected to grow 80-fold. So there's a lot of market share to be grabbed. Which companies will win? That's one of the big questions in many technologies. And that's one of the very exciting reasons why with a fund of funds, you get to bet on all of these horses. It's a very busy slide, but let me kind of take you through the main message of this. So hydrogen is expected, sustainable hydrogen is expected to grow 80-fold in terms of demand. Who will be the winner? Who will be producing and selling most of the green hydrogen? We really don't know yet, because there's many different ways of making hydrogen. On this slide, you see 4 different ways from 4 companies in our portfolio. So all 4 of these companies we've helped fund. And just to give you a sense of the different flavors, on the left-hand side, we see Syzygy. Syzygy makes gray hydrogen, so it's still made from natural gas, but they do 2 things really well. One, they make it with light instead of heat, making the production process much more efficient. And secondly, they capture the CO2 that's released as they make the hydrogen. So it's really quite low carbon footprint hydrogen already, and a technology that can scale very quickly, making sure that we reduce emissions in the near term. And then on a slightly longer term, we expect green hydrogen to grow. But even within green hydrogen, we don't know exactly which technology will be the big winner. green hydrogen is the stuff that's made from green power. So we use electricity and water to make hydrogen. Electric hydrogen on the left-hand side does that with a technology called PEM, which is promising but quite novel. And Sunfire, another company is based in Germany, actually has the two other technologies. They're developing both of them. Alkaline, which is like the really established way, the way most green hydrogen today is produced. But they're also developing solid oxide, which is another very exciting next generation technology, which if it will succeed, it will be much more efficient. And then finally, white hydrogen. I didn't know about this stuff until probably 12 months ago. And when I posted it on LinkedIn, everybody got super excited, including a bunch of professors and high up policymakers in the US, because it was such a novel thing. But basically, there's a whole lot of hydrogen in the ground, and it looks like maybe we can drill it out efficiently. And if we can, again, this will be one of the big game changers. We have exposure to the leading company in the space, Coloma, and we're tracking them closely to see what happens. So many different options that will get us to that 80x. And because they're early stage, good to bet on all of them. And then maybe one final point on the whole market. Let's zoom out a bit. So we've talked about what technologies, what drivers, what near-term growth, which companies. How about the capital? So first of all, on the left-hand side, you see the expected growth of the market overall. So certain markets will grow 80x, others will grow 3x. In total, we'll see the whole climate tech revenue size of the pie more than double between 2020 and 2030, and expected to grow much, much more beyond that. But that also means that we need to double investments into the space. And so on the right-hand side, you see historically how much was invested in climate tech, which is about 2.5 trillion, and we need to get that to 5 trillion in the next coming years. Hope that gives you an overview. Handing over to Wiebe to talk a little bit more about the private equity universe.
Yes, thank you, Lisa, and good morning, everyone. My name is Wiebe and I run the investment team, and happy to provide you with an intro to the climate private equity market and some of the trends before we dive into the Fund 3 in more detail. So what's the role of private capital? It's really threefold. On the one hand, it's venture capital that really drives innovation. We have growth capital and buyouts. Lisa, maybe we can go to the next slide. So venture capital, there an example is Noon Energy. They produce the next generation of long storage battery. So those are really batteries that can store energy for up to days instead of hours with the current technology. Growth capital is needed for companies where there's already product market fit or where technologies have been proven at pilot scale, but they just need to scale faster and grow, like Soli. It's a European distributor of home solar products, market leader in the Netherlands, strong position in Germany, and they want to conquer Europe. And then finally, it's buyouts. So companies that are already profitable, but this is really building global leaders either through M&A, and we need those as well to either offer enabling technologies or critical components, but this is really the more mature end of the spectrum. And we need all of that. It's not a niche strategy anymore, climate tech. So whereas in 2020, it was approximately 20 billion market, right now it's closer to 50 billion per annum that's being invested in these type of technologies across all verticals, all industries. And especially as you look at it as a percentage of the overall private equity market, there's a stellar growth. So it started to be 6%, and by now it's closer to 15% of all private equity transactions can be defined as climate tech. And it's fairly resilient. So the past 2 years have not been the best years in private equity. The deal flow hasn't been great, really as a result of higher inflation and higher interest rates. And we've indeed seen also a slowdown by deal volumes in climate tech, but only a small decrease versus the overall private equity market. So it's fairly resilient, and it's really a matter of what's the excitement in this domain. And all the regulatory push that's driving the deal flow. So it's a good dynamic, and it's fair to say that in the first quarter of this year we do see a pickup. So it's increasing again versus 2023. So what is really behind it? Lisa already mentioned it. It's really, on the one end, the regulation. And the IRA has been a phenomenal boost, and we see it across our portfolio companies in the first two funds. Many of them are beneficiaries of all the subsidies that are being handed out. And that's really driving adoption of new technologies and reducing the green premium fairly quickly on many of them. Secondly, what we do see is that valuations have come down. So 2021 especially was characterized with very high valuations. But there, the drop has been very clear in 2023, especially in growth equity, where the round valuations have come down. So we think it's a more benign environment now to invest in this space, and we have seen a slow shift across our portfolio towards growth as a result of it. But I'll get to it when we discuss portfolio construction. So these are data points from Cambridge Associates on how top quartile private equity returns compare to public equity. And you can make all sorts of arguments about whether this is a fair comparison. But the one thing that I want you to take away from this slide is that it matters if you can get into the best funds out there. So the discrepancy between the top performing funds and the average or lower performing funds is quite high. So what does a fund of fund do? They select the funds and provide access to the funds that are notoriously difficult to get access to. So that's indeed what we aim to do with Portfolio 3, providing access to the best funds that invest in climate technologies. So how does this work? With your investment, you commit to our carbon equity portfolio fund, and that fund will then commit to 7 to 10 specific funds that invest across the various stages. Could be a venture capital fund, could be a growth equity fund, or could be a buyout fund. So with your one commitment, you get exposure to 7 to 10 funds in there, and then ultimately have more than 150 exciting climate technologies and climate companies in your portfolio. You're not the first one to invest in this product. 700 investors were there before you, and we have invested more than 200 million of their capital in such a product. We do get the question often, so why fund of fund? Well, first of all, a fund of fund just unburdens you. So we do the work for you. We screen the market. We speak to all managers and then select the best funds for you. But secondly, it provides you a better diversification than just investing in a single fund. Now, on the buyout side, is less of an issue. If you pick a fund, on average, you will do as well as the performance of a fund of funds, according to Cambridge Associates. But in venture capital, the range of outcomes is much more volatile. And given that we do have some venture capital exposure in there, building a diversified fund of fund will increase the average exposure based on past results. So how do we construct the portfolio? And for Fund 3, we aim to do it in a very similar manner as to Fund 2. So out of the 7 to 10 commitments, we invest across early stage venture capital. So those are really technologies that are either at lab scale or spin outs from universities or new services that don't have a product market fit yet. So very early, and you really back the founders, and ultimately you hope to back the founders that have done it before, that have that experience, but at least have a great idea for a big problem. We expect to make 2 to 4 commitments at that stage, tend to be somewhat smaller tickets. So we try to given the higher risk profile, reduce the commitments in size a bit, but we do want to have that exposure. Then we will make 2 to 4 commitments at early growth. So that's really Series B and C. At that time, a technology is proven at a pilot plant scale, or a service has product market fit but just needs scaling. It's still not profitable, but it's really about growing faster. And we'll make 1 to 3 commitments in late growth to buyout. So then the company is either close to profitability, already profitable, and also still needs to grow. So we're talking about Series C plus, either pre-IPO or already profitable and being in buyout. Now, in Fund 1, we had more early stage venture capital. For Fund 2 and Fund 3, we will have more growth equity type of funds in there. And that's because 1, the valuations are more attractive at the moment, like I explained. And 2, because really we see a lot of the technologies mature. So the ones that were in our Fund 1 early stage venture program, we see them now appear in the growth equity funds. And those tend to be the companies that ultimately will get there. So many of them are the ones that attract the funding from the IRA, that really get the larger growth equity funds to be excited about them. So we want to follow them across their maturity curve. We do have a sleeve of up to 10% to do co-investments. So the thinking behind this is many of the companies within our existing portfolio or in the portfolios of our relationship managers that are doing very well and that raise follow-on rounds, and where our relationship managers cannot pick up their pro rata, then we have a chance to invest alongside them. But only when there's real traction, when there's no tech risk anymore, when we don't have to pay fees and carry, so it's really enhancing the returns. Then we might do a co-investment. Where the bar is high, it's really more a mature type of investment where we can take pro rata rights from our existing managers. Split by geography, it's a balance between Europe and North America, maybe slightly more North America. We do see that the pipeline there is stronger, but we try to make at least 40-60, but potentially 50-50, depending on ultimately which funds we will see. And it's very spread across all the industries. Like Lisa said, we need to decarbonize all the sectors of the economy. So far, Fund 1 and Fund 2 touch upon all those different segments, and we'll do the same for Fund 3. Try to really make it balanced, and that with your commitment to one fund, you get exposure to really all these type of technologies that tackle all the industries.
Wiebe, if I can stop you on this slide, there is a question here on our geographical spread. So why is there only a focus on Europe and the US, for example, not Asia? And is the majority exposure to the US not a bit risky given the future political climate?
Yeah. The opportunity set outside Europe and North America is really small. So we do come across a few funds in the past 3 years, but there are really not that many. So it's just a matter of, where are the funds that we can pick and choose from, and where are the managers that have most experience? We will track them. Maybe over time, we could add a few if there are more mature managers in other regions, but so far there are just not that many. From the political point of view, you're right. I think there's one candidate that's more favorable for the climate, one maybe a little bit less. So that could have an effect on how fast will this transition go. But I think the train has left the station, right? So it's going in one direction, and could it be slower with one versus the other? Yes, potentially. On the other hand, if you look at where the IRA spending happens most, it's in the red states. So a lot of the momentum is being built in those states, and we don't think that funding will dry up, and that even Trump will realize that this is good for his base. So is there a regulatory risk? Sure. The same goes for Europe, by the way. But overall, there's so much happening, and so much capital is flowing into this direction. There's a lot of corporates who are spending and investing in decarbonizing their plants and their operations. We don't think it will result in a complete stop, for example. But sure, there's a difference between the two, but we will make a balanced approach, and obviously we'll follow it closely. So just to make it a bit more tangible, I'll present 3 funds that are currently in diligence. The first one being TPG Rise Climate 2. So TPG is one of the well-known big brands, private equity firms globally, but we're one of the first movers within to move into impact. So they set up TPG Rise to really make impact investments already well over a decade ago. And 3 years ago, they launched a specific climate fund. So their first TPG Rise Climate Fund, really dedicated to decarbonization through buyouts and growth equity investments. So we have been talking to them now for close to a year. They've launched their second fund, which is a continuation of their fund 1. So still buyouts, carve-outs, and growth equity investments. And what we like about them is that it's really a highly experienced team, very credible investor, that has a specific team focused on impact and analytics, and has a research team called Y Analytics that helps them go after the most impactful deals, that can assess all the technologies, and that really makes sure that the type of investments they're doing matter from an impact point of view, but combined with huge experience also on the financial side. So really those two come together. And given that they're raising a very large fund, once they invest in companies like Form Energy on this page, they can really make or break these type of companies. So they can pull them through the so-called missing middle, where there's a lot of capital needed to build the first-of-a-kind plans. Once TPG steps in, a lot of things are going into the right direction, and they bring a lot of relationships with potential off-takers for any of these solutions that they invest in. So that additionality at that level, at scale, we really appreciate. And the investments in their fund 1 are also very exciting from that point of view. So we see traction. They've had 2 exits already in that fund 1. So impact and financial return go hand in hand. So we're spending quite a bit of time on this fund. Maybe on the next page, we show here, so what are the type of investments, right? So what is this? What has their fund 1 been doing? Now, on the one hand, they've been investing more in type of mature businesses where the operational and existing tech, so there's no tech risk. It's all about growing companies faster. It could be Enpal, which is also a European residential play. It could be Agas. That's really a buyout deal. But it's not only buyout and carve-outs. They also invest in existing tech that just needs scaling. So that's the middle point. So it's development of existing tech, but it's a bit earlier in the phase of the companies. And on top of it, they also invest in kind of breakthrough technologies that still needs to be proven at large commercial scale. So they do all 3. Form Energy is an example. It's a long storage battery, like Noon I presented earlier on. Form is a little bit further advanced, but they also have a technology that can store energy for up to 100 hours. And with the capital of TPG, they're building now their first large-scale plant. So this is what you could expect from TPG, a very balanced global portfolio of companies that invest in the transition. Another fund we're spending a lot of time on right now is DCVC Climate Select 1. So DCVC is a deep tech investor, venture capital investor from the US. And they have already raised more than 3 billion. And they have been investing in deep tech across sectors. So in synthetic biology, in AI, in computational biotech and health. So really deep tech, data-driven investor. And they've created a lot of value for their investors with their main core programs. And they now raised their first climate-specific fund, which is a little bit later stage than their core programs. It's Series B and onwards, when the tech is a bit more de-risked. And they've built a specific team within their organization, but with the oversight from one of the 2 co-founders, being Zach Boak. So he founded the DCVC and is is overseeing this program, but on a day-to-day basis, it's being run by Rachel, Slaybaugh, and Kristen, and a new partner who will be announced soon. And what we find very exciting about this opportunity is that 6 from the 12 to 15 investments, they're already in the fund, so we can assess them. And it includes Fervo, which is a geothermal producer, at 12, a company that makes chemicals and synthetic aviation fuel from carbon dioxide, and Switterco, an exciting new technology to filter water much more efficiently. So the excitement here is really in the visibility that we have on the portfolio, the traction, some of them have already been written up since their entry, and the experience of DC Visser as a deep tech investor. So this is an exciting one, and we're fairly far advanced in our diligence. And then finally, a third fund that we're looking at right now and have done quite a bit of work is Verdane Idun 2. So Verdane is a growth equity investor from Europe. They have already more than 3.5 billion of assets under management. And it's a very intentional investor focused on, with this fund specifically on energy transition and resource efficiency. Bjarne is overseeing this strategy from the firm. He founded Verdane, but he has 2 persons who are running the fund on a day-to-day basis. That's Erik Osmussen and Eric Becker. And those and here as well, they've had a Fund 1 already, so they're doing now Fund 2, which is even more focused on climate than the Fund 1. Fund 1 had a slightly broader strategy. And some of the investment they've done is rematch, so that's really recycling of synthetic turf. And they've been investing into the EV charging infrastructure. It's more digitally driven companies sometimes, but it's really growth, hardly any tech risk, but it's an experienced team. So we're spending time on this one, going through the portfolio, trying to understand how this one compares to any other fund. But we like the fact that it's an established manager that has created a lot of value in the past, and that they're very intentional about what they're doing. That's important for us. Now, those 3 are really the near-term potential opportunities, but we have a much broader pipeline. We have pretty good visibility, forward visibility, also for Fund 4 and Fund 5. That's the good thing about this market. You know when funds will be coming to market. Sometimes a new one pops up, so we track them all. But it's an exciting one. It's a balanced mix between North America and Europe, and also balance between early stage and later stage. So the first 3 I showed you, TPG is really later stage and some buyout. DC Visser is early growth, Series B and onwards, and Verdane is late growth. But we do have also in the pipeline earlier, so like pre-seed and seed funds in there. And we want to have a balanced portfolio covering all those stages. So what's the track record of our prior 2 funds? It's a bit early. So if you look at our climate tech portfolio Fund 1, that was our 2022 vintage year program. We raised 42 million. And by now, and this is a bit outdated, so this is Q3 data, by now we're over 30% invested, and we'll get to close to 35, 40 soon. 9 funds have been committed out of Fund 1, and by now I think 67 is also per Q3. Where I don't know, Carol, where are we right now?
I think we're at 135 or so companies total across Fund 1 and 2.
Across Fund 1 and 2, okay, yeah, so well over the 67. And from a return point of view, it's early, however, on a gross basis. So if you disregard fees and carry, there's no carry being paid yet, but if you disregard fees, the portfolio has been written up to 1.1 times. So there have been follow-on rounds at higher valuations that are driving up the return on a gross basis. If you then subtract the fees that have been paid to the underlying funds and to carbon equity, it's marked at 0.9 times, which is nothing to worry about. That's just the J curve. And it takes time for the portfolio revaluations to make up for the fees that have been paid. So after 3-4 years, we expect it will be closer to cost. And then thereafter, it will grow and once the portfolio matures. What we track is the percentage of the portfolio companies that are substantially contributing to net zero. That's for us a very important metric, because that shows, are we actually tackling the climate problem, or are we investing in companies that do not matter? So that needs to be at least 70%. That's how we set it out at the start. You could argue, why is it not 100? Because sometimes we invest in funds that are slightly broader from an impact point of view. So we invested in a food and agri fund that also tackles biodiversity. So on a portfolio level, we say it needs to be at least 70% substantial decarbonization. And for both of the prior funds, we hit that number. Climate Tech Portfolio Fund 2 is still early. We raised 95 million. By now, we have committed to 9 funds. So we've added 3 more, and that fund has now been fully deployed as well. Not fully called, of course. It takes 4 to 5 years to call the majority of the capital, but at least all the investments have been identified, and some are still in the final stages of closing. But we have shifted our attention to Fund 3 from a deployment point of view.
We have a couple questions here, Wiebe. So the first one from Wim is, with only 35% invested from Fund 1 and close to 0% from Fund 2, is it not a bit early to raise money for Fund 3?
Yeah, so the way the private equity works, right, the underlying funds have a 5-year investment period. So for a 2022 vintage, you would expect that after 1 year, 15% is deployed, after 2 years, 30, after 3 years, 35. And given its venture, a lot is reserved for follow-ons. So even after the investment period, more will get called. So that's the normal cadence. That's what you would expect. It's not behind. It's really the normal investment phase of these funds. But what's important if you invest in private equity is that you have exposure to all the vintages. You don't want to miss out on a certain vintage, because 1 year could be more attractive than the other year. So spreading it over vintages is the right approach to achieve the best returns in private equity, and missing out is probably what you want to avoid. And we want to offer our investors the chance to indeed build a portfolio over time. So yes, it's early, but it's on track. And the thing is, investing on a continuous basis is the best strategy. Now, more optimistically, we started in 2021. We started with a handful of clients, built it out to a larger pool of clients. Many of you didn't know us yet, so there wasn't an option for you to invest by then, or we couldn't reach you. So right now we have many more people who are interested, and not being in the market would be a shame, because we miss out on that capital that we need to scale these businesses. That's a more optimistic answer. Was there another question, Karen?
A similar question, maybe you can give a bit more detail. So it's about, what is the expected speed at which the 100K minimum call will be invested? So maybe a bit overview on how it goes throughout the years.
No, it's a good question. So we indeed have this 100 million upfront capital call due to regulations. We need to call the first 100K, whether or not you commit 100 or 500. But so from a deployment point of view, it works as follow. Underlying funds will probably call 15% per annum. That's what we've seen so far. So really, it's 15%, 30, 45, and up until the end of the fund life. That's really how it gets deployed. Now, if we have that upfront capital call, there's a substantial amount of that. If you commit only 100, there will be an advance payment that we will just hold as cash on a savings account where you accrue some interest. But that's how we deal with it. There's no risk of losing that capital. We will not take that risk, but it indeed takes at least 5 years before the majority of it gets drawn down. But there might be a chance it will not get fully drawn down. Shall we move on?
Yes.
Okay, so it's early to really show financial performance, right? We saw the 1.1 gross money multiple, but it doesn't really tell a lot. It's too early to tell. But what we can show is the traction we're seeing across our portfolio funds. So in the portfolio companies, 24 follow-on rounds we've had so far. And that is more than 30% of the companies that have been in the portfolios longer than 1 year have successfully raised more capital. And especially for this venture and growth type of opportunities, it's important that these companies are able to attract more funding. It's a sign of at least they're onto something. So we're pleased with that progress. And in total, they've raised more than 2 billion. So it's significant capital that they've been able to attract. And one just fun fact, 5 have become unicorns by now. So they raised its valuations more than 1 billion. So here, on this slide, we show 2 of these companies that indeed have raised successfully. One, Forum Energy, which I already mentioned, the long storage battery producer. We invested in Forum through Energy Impact Partners, the Frontier Fund, in our Fund 1. The round we entered was the Series D, and in the meantime, they raised a Series E at substantially higher valuation with fantastic other investors in the cap table. So Breakthrough Energy Ventures is in there. We see Capricorn, but also strategics like ArcelorMittal. So it's great to see such strong investors support these type of companies. And a very similar dynamic with electric hydrogen. That's the electrolyzer manufacturer that Liza already mentioned on the hydrogen slide. That company also raised multiple rounds since our entry. And again, a very strong cap table if you look at the parties who have invested. So these are clearly 2 of those companies we're very excited about, not only from the impact, but also from the financial point of view.
We're getting an interesting question I'd be happy to take right now from Giel, which is, do we take the congestion of the electricity grid into account when we invest? And so, for example, with electric hydrogen, how do we look at their electricity requirements and whether now is an opportune time to invest? The answer is yes, absolutely. So on 2 levels. First of all, for us, it's very important that the fund managers that we work with have a really in-depth understanding of the broader energy transition and how the different pieces intersect. We call this a systemic view, because indeed it's essential that a company like electric hydrogen will have the electricity needs, but also the other way around, that you wanna, if you're trying to solve a specific piece of the energy transition, you want to solve it in the most efficient way given the broader context. So, for example, from energy, one of the things we really like is that they're not using lithium, which is a scarce resource, and we really need another application such as EVs. And rather, they're developing an alternative to using lithium so that we can use the lithium that we have in limited supply, at least at the moment, where it's needed most. So it's something that we really test our fund managers on, and it might actually be a very nice segue to our next chapter, which is around how do we select funds? Because this is one of the things we look at. But I think what's very important to understand our selection approach is that we invest in funds that are blind pool. And that means that at the time that we come into these funds, they've only just started deploying the capital. So that means that out of the 20 to 30 companies that a fund will invest in, they'll only have made 2 or 3 or at most 5 or 6 investments. There's a few specific deals to look at, but mostly it's also around really building conviction that a fund manager team will, after we commit, continue to deliver on the types of investments that we find really exciting and important. Given the limited time, I'm gonna quickly skip through a few and then make sure that we still spend a bit of time around how do we actually select. In the meantime, I'll urge you, if you still have any questions to ask, there's a few unanswered we'll definitely get to, but if you have any others, make sure to ask them now, so I'll make sure that we reserve time to answer them. So this is our team, investment team of 7 full-time. Dirk Meuleman on the top right is our external IC member. Next to that, a few other superstars in the team. In the bottom are extensive backgrounds. We also have a whole lot of network around us. So on the top, all of our strategic advisors, some of them we really have weekly or monthly chats with to make sure we get the best insights from the industry. On the bottom left, really quite an extensive pool of other fund investors that we have regular chats with, both to make sure that we don't miss any funds, but also to exchange notes on how much we like these funds and what is important to look at to get references. And on the bottom right, an overview of a few of the climate impact initiatives that I'm and we're actively involved in to make sure that we stay up to date on best practices and we continue to really actively support the development of best practices. This is the investment overview of the funds we've committed to so far. As you see, 2024 is still a little bit of a room for more commitments to be done. We already talked quite a lot about what is up next, and there's a few still for Fund 2 that we have IC approved, but still going through the onboarding process, so not on here yet. And when you look at the spread of the funds we have chosen, you see really, as Wiebe explained, a very nice spread between US and Europe and early stage and later stage. Skipping through, if you have any questions, do feel free to ask. We track the whole landscape. By now, we've found more than 600 climate venture capital and private equity funds in our universe. And just to give you an overview of some of the names, this is what that looks like. So Europe, North America, venture capital and growth, really quite a lot to choose from. Of those 600 funds, over the last 3 years, 338 have raised, so have been actively looking for capital. So those we've entered into our funnel. 23% of those we've taken to quick scan stage. So this is an overview of how we actually invest. So first we take funds to quick scan analysis. It's a 2 to 4 hour exercise based on a pitch deck and a first intro call with the fund manager. And there we make a quick analysis of what we like and potential red flags. Of those, 44% we've taken into climate due diligence. Talk a little bit about what it is that we do there. Finally, we also do an ESG analysis. I know there's one only partially answered question on that. I'll get to that in a minute. And we also do a full financial due diligence. It looks like on the financial side that we're not very critical. We really are. So just to explain, between the 338 and the 77, many funds drop out for both impact and financial reasons. So that 77 is already the top 20%. And as climate and financial performance do correlate, typically once funds get through climate due diligence, we've already done quite a bit of work on financial. And so many of those do come to IC. This is the heart of our climate due diligence. I'm really running through now. I hope you don't mind. In total, we look at 30 practices that we think are strong predictors of climate performance of a fund. So there are 30 items behind the 10 topics that you see. And zooming all the way out, in total, we look at 6 themes. So we look at the mandate. How clearly is a decarbonization integrated in the investment strategy that's also legally put on paper? And also, for example, how clearly has a fund defined what they think is a good or impactful impact investment versus not? So we talk about the impact threshold there. Then on the organizational side, we look at 2 things: the climate knowledge of a team. So do they have that systemic understanding of the transition? Do they have the right engineers in their network to assess specific technologies? But also the impact organization. So is there a clear head of impact? Do they have the right mandate? Do they regularly review their approaches? The investment decision is the biggest bucket. It's because we think it's the very single most important thing. Where is the money actually being invested into? Because with the capital, you fund companies' growth. So making sure that funds fund the best technologies. And that starts at how is impact integrated in deal sourcing. Then it's about how do they actually do diligence on impact. And finally, how do they take that impact information into account at actual decision making? Monitoring and reporting is important. These are more established practices. Here we don't do much new under the sun. Finally, we do look very much in depth at a fund's track record, impact track record, where deal by deal for all of the past investments that a fund has done, we assess how important we think that technology is for net zero. Skipping through how we do that precisely, but you can find more impact information on that in the data room, and also happy to describe that in more detail if you want to know after this call. Before we go to general DD, maybe quickly to answer a little bit more on the ESG question. So there was one question in the chat around do we also look at the broader impact of deals? So not just their GHG mitigation potential, but also, for example, their broader environmental and or social impacts? And the answer is yes, absolutely. So first of all, for every fund manager, as said, I'm just quickly jumping back. We do an ESG assessment where we go into a lot of detail on how do these fund managers per deal assess the broader environmental, social, and governance criteria, impacts of an investment, what are the kind of things they don't want exposure to, how do they manage when there's active like risk. And we go into a whole lot more detail if a fund invests in specific sectors where there's above average ESG risks. A few to think about there is mining, drilling, carbon storage, and anything agri-food. And so, for example, with Coloma, yes, it's very important that if they drill responsibly and in sites where the environmental impact is limited and managed well. So this is something we have very active conversations about. It's not perfect. Getting to net zero is not perfect. It does require us to do some additional drilling, but let's make sure that we minimize the damage that we do. Okay, there is a few more questions that I think are worth discussing, but very quickly, two words on general DD if you want, Wiebe.
Yeah. So once a fund passes our impact scorecard, and that stage, we move on to the full financial diligence. And this is what you can expect from a fund manager. We go through the whole team and organization, making sure that they have strong track records, that the governance is good, that the right people are incentivized, we have strong alignment with the team. But also whether or not their investment strategy is sound. So how do they source the investments? How do they select the investments? Are they going after the biggest problems that we think are worth tackling? And then finally, we spend a lot of time on the fund terms. And here we do see that lately it's becoming a little bit more LP friendly. So the terms are becoming less aggressive than we started 3 years ago. So that's a good development. Now, one thing that's important, of course, is that track record. Whenever there is a realized track record, so that they have sold companies in the past, that makes our life easier. We can really dive into those numbers and we dig deep and try to understand what is behind those realizations, what went right, what went wrong, what are the lessons learned. But also when a fund manager is a little bit more emerging, we dive into the unrealized portfolio and we go quite deep. So first of all, we want to understand who did they invest with? So how does the investor community look at them? Are they with other strong investors on the cap tables or not? And if not, why not? Do they have an exceptional deal sourcing approach, find opportunities that others don't? Or are they not allowed into the more exciting rounds? So we speak to other fund managers to really understand how do they look at this fund manager, and it's very collegial, especially in the venture and growth side. That's different from buyout from a dynamic point of view. Then we dive into the unrealized portfolio itself, really understand what is traction on a revenue level, profitability, if there's any, but it's mostly on revenue and gaining new clients, and how does that compare to the original thesis? That's very important. Are they on track or below track? And how much more runway is there? What's the next financing round looking? And then thirdly, we look at the valuations of recent deals. So are they paying up? Are they sensible? That's for us very important. We do see some funds that are more aggressive than others. Picking that up early is important. We want to make sure that we enter a fund that's investing at reasonable valuations. And then finally, we do reference check with portfolio company CEOs. Very important. Really try to understand what is the added value. It's their style. Do they add anything to their cap table and to the strategy? So that's really how we try to get more comfort around the track record and the value add of the managers.
Thank you, Wiebe. We are at time, so I'm skipping the terms for now, but do reach out to us or the person you've been in touch with so far if you have any questions on those. Finally, just want to reiterate, the first close is coming up very shortly indeed, June 20th. Thereafter, the fund will remain to be open, so Joris also answering your question. There will be 2 more closes, one after the summer and one at the end of the year. Those two closes will not have the first close discounts, so just so you're aware, but there is plenty of opportunity left to still step into the funds. There's two other questions that are worth answering, but for the people that need to drop off on time, I just want to thank you so much for joining the webinar. We'll follow up with a recording of this webinar and any other next steps. So have a great day and weekend ahead. Then for the two questions that we still have, one is from Jeroen. Nice to see you in this webinar, Jeroen. You're asking about the effect that potential, or not potential, actual elections in both, I guess, US you're asking, but maybe also Europe might have on this opportunity space. It's a very relevant question. It's a question we spend a lot of time around thinking about, reading around, talking with our funds around. In terms of the IRA in the US, we're reasonably confident that at least parts of the IRA will continue to exist for a few reasons. One, it's quite an extensive policy. It's not very easy to unwind. But two, more importantly, most of the capital of the IRA has gone to red states. And it has really given a boost to local economic development, local job creation, especially in Republican states. So for Trump to withdraw the resolution or the policy will be really quite painful. Will there be partial withdrawals? Will there be a little bit maybe more limits on the total capital available? Yes, quite likely. Will it be a total rewind? Not very likely. And also certain institutes are really preparing for a potential Trump re-election and making sure that as much of the money is safe. So for example, the Department of Energy, the DOE, had 27 billion to give to other funds that would invest that capital into green projects and green technologies. And they doled up out all of that 27 billion at once last April, which nobody expected. But as certain people in industry have said, they just slapped the money over the counter, so it can't be withdrawn. So that is my view. Wiebe, maybe you want to give yours?
No, I agree. I agree. So I already mentioned it during the webinar. So no, nothing.
Yeah. All right. Then there is one final question. It's and when will the 25K tickets for the carbon equity funds be launched? We are working very hard on potentially still making that possible for this fund, and we will keep you updated on that in the near term. If you're interested, we really suggest you sign up for the waitlist in the portal. And then the 25K for this fund, if we do it, it will be a limited edition for very specific reasons. At scale, we expect to launch the smaller tickets early next year, but we are still working through a regulatory minefield, if I may put it elegantly, but working very, very hard to make that possible. And we will keep you updated, especially if you're signed up for the waitlist. All right, that's it, folks. Thank you so much for joining. Have a great day, and we'll be in touch. Goodbye.